The liquidity rotation model consists of two main concepts. The first one is the internal range liquidity to external range liquidity, and the second is swing highs and swing lows. These two concepts can be combined to give you a perfect reversal point with a very high win rate. We already know that when price is at an internal range liquidity, it will most likely target an external range liquidity. And when price is at an external range liquidity, it will most likely target an internal range liquidity. Now, in this case, the internal range liquidity is the fair value gap, and the external range liquidity is the highs and lows. Since we know that when price comes into an internal range liquidity, it will almost always target an external range liquidity. The next question is this: where should we take our entry? Should we simply enter at the start of the fair value gap, our internal range liquidity? That can be a good entry, but sometimes the risk to reward just won't be worth it. So the best two ways to take an entry from an internal range liquidity while getting a higher win rate and a better risk to reward are: 1, the use of a lower time frame confirmation, and 2, the use of what we call an overlap high or an overlap low. Today, I'll be explaining the use of an overlap swing point for entries. So, what is an overlap high or an overlap low? An overlap high is formed when a swing high overlaps with a fair value gap. This combination creates a very precise area for price to reverse from. For example, let's say you finished analyzing your higher time frame, and your drawn liquidity is above price. Then you see the market create a swing high, followed by an impulsive move to the upside that leaves behind a fair value gap. And that fair value gap clearly overlaps with the swing high. That becomes your overlap high.